Powell made this analogy. He said something like, well, when you're driving in fog and visibility is reduced, what do? You slow down.
If they need to guide towards a cut in December, they have plenty of speeches, endless speeches where they can do that. So, may as well just hedge your bets a little bit while you have no line of sight into economic data.
I think once that data releases, they're going to have some egg on their face because the job market's going to still be pitiful.
It's just hilarious to contrast these valid obsessions with these flows and memes ideas. And meanwhile, comparing just the absolute banger earnings that we've been getting so far this week. This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance, Roundup Edition. Back to the trio after we got a lot of good feedback on last week's show. Hunter Hawcroft, that was an awesome conversation. So, Tyler, shout out to that was your idea and your initiative, and I think people really liked it. I saw a lot of good feedback. I really enjoyed the conversation. I don't know about you guys.
Yeah, I mean, I thought it was good. But hey, viewers out there, if you read anything interesting that's like divergent thinking, we are always open to it. And sometimes the best ideas come from, smaller, more idiosyncratic, interesting thinkers. So send them to us.
Totally. Yeah. Let us know if you like that model of having like half an hour up front, kind of mini interview style roundtable, and then moving into the content afterwards, kind of trialing some different things. So yeah, I thought it was great. Really good dude. Very smart.
To follow up on that, Hunter sent me this. Hit me with slide 43. This is kind of fascinating. Just to close the loop. This came out literally, I think, a day or two ago, but Joe Lonsdale and Apollo are partnering. And it says, well, venture capital, and I apologize, I'm going to read this because there's some guy roasted me for get Tyler to stop reading stuff. But it's so good. Well, while venture capital is suited to funding technological breakthroughs, it's not sufficient to fund huge projects that are required to increase our national productivity with the next wave of transformation technologies like AI, robotics, autonomous systems, biotech, nuclear energy. And then at the bottom it says there's a growing need for creative, non-dilutive capital to support the companies driving industrial innovation. So Apollo is basically the private equity markets are just going to finance more and more of the actual big, large CapEx stuff. To Hunter's point, crowding out and then probably creating more meme-tastic behavior in public markets. But so this is where, when I started, this is not to get too philosophical, but when I started in the business, it was the handoff from floor brokers to like algorithms in terms of trading. And then New York Stock Exchange and all the floor brokers inevitably just became like this artifact where they're just there and like very few people are even trading anymore. I got one guy that's incredible on the floor, but besides that, it's like it's a ghost town. It's a museum. And my brain goes to when I see this is like, are public equities literally just the ghost town of where the floor brokers used to be? And you just have this like weird, systematic public equity market controlled by robots and algorithms. And then, the real industrial innovation is coming in private markets. So that was just market structure thought I had. Let's kick it off.
Good point. Cause you only get the public market bid if you're like a Ponzi. So
yeah. And consistent alpha is hard to find in the way people manage money in public markets now. So it's,
for what it's worth, it's the same in the crypto token market. Like if you're a real company that makes revenue, investors don't like that. So it's only like the memes and Griff's tokens that pump. So like you're best off not having it's adverse selection because then the good projects don't want to issue tokens.
And in the public markets, the craziest thing is because of this systematic Ponzi scheme that we're in. Mark 333, 337, Ponzi. This whole thing, no active managers can beat piling into the fangs. And it's just, there's less and less active managers that can actually beat it because the sensitivity of the floats are getting so crazy. So I don't know. Weird. Things are getting weird.
Things are getting weird. All right, so we're recording here October 30th, day after the Fed meeting, and we finally had a Fed meeting that was a bit more exciting than just talking about changes in the interest rate. We had some wonky, nerdy balance sheet stuff to go through. So, okay, going to go through a few slides here, just get everybody up to speed. First off here, they cut rates 25 bips. Everybody expected that, but what was interesting is that there was 2 dissents, and gotta go look back at the data, but I wonder when was the last time that you saw 1 dissent one direction and 1 dissent in the other. So you had Stephen Rand go advocating for 50 bips, and then on the other side of things, you had Schmidt who was advocating for no cuts. Quite a big hawk. So that was interesting. And then you also had some of the updates in terms of quantitative tightening. So we'll get into this. I have a few more charts here, but we've been talking the last couple of weeks about some funding market hiccups and how we were starting to get out of that abundant reserve regime into ample reserve and getting very close towards that scarce reserve regime that was basically the bat signal to end quantitative tightening. So that all is coming forth here. Powell announced that they'll be unwinding quantitative tightening starting December 1st. And what was really interesting too is that straight into the press conference, pretty quickly, Powell came out swinging here. He said a couple interesting points, which I'll pause after here and get your guys' takes. But one of them was that, if you looked at Fed funds pricing going into that meeting, everybody was expecting a cut to be locked in for December. You can see here, just looking at the pricing beforehand, is basically a shoe-in. He came in and said that is by no means a guaranteed to be cutting in December. And I think that really, hit the nail on the head of just how much dispersion there is in perspectives at the Fed right now. Obviously, you had dissents in opposite directions, and that just really, hits the nail on the head on that. So, really interesting pivot that really took a lot of the excitement out of markets. We saw bonds sell off. We saw equity sell off a little bit, and just much less odds around that cut in December. Quinn, you actually wrote something on this. I'd love to just get your read on why you think this came out like this.
I don't know. I'm speculating, but when I speak, it smells like some sort of threat or nudge to the administration to say, reopen the government. Powell made this analogy. He said something like, well, when you're driving in fog and visibility is reduced, what do? You slow down. Basically saying that if there's no government data or adequate government data before the December meeting, that they might slow their path of cutting. And it's interesting because I don't recall a time ever that Powell has commented on market pricing so explicitly. In fact, I remember many times, probably every press conference, he gets asked about markets. Like this time he got asked about Meg 7 and AI. He gets asked about that every meeting, gets asked about rate cut odds. He got explicitly asked, and he basically said they're too high. And he said effectively that it should come down dramatically. And I thought that was very unusual. And then the second thing is just how this reaction function, and I think what the market's struggling with here is there's just no world in which the shutdown, even if it's transitory or reversible, which, as Besant said, you're starting to maybe eat into the muscle of the economy here. There's no world that the shutdown makes the labor market stronger. And so there's only downside risk. And so I think the market's struggling because that reaction function to slow down with no data because of the shutdown actually exacerbates the downside risks. So, there's probably some positioning going into it that's getting washed out. And ultimately, odds over the last 24 hours actually of government reopening next week or the week after have gone up. So I think it gets resolved. The data comes out. I think inflation shows reduction the next 2 months. Labor market probably doesn't show any uptick. Maybe it doesn't show like drop off a cliff, but it's unlikely to show any meaningful improvement. And they probably still carry through with December. But this does shift things from a liquidity perspective, because I don't know if you have that chart that shows cuts out through March that have fallen off quite a bit. So it puts the onus on either the data to prove it is weakening or inflation is improving to get kind of more cuts behind this next one. I still think they go in December, and the market obviously with 72% believes that as well, but it's a much less preemptive liquidity stance from them.
Yeah. And I think he just wanted to get optionality too, right? Like with no meaning in November, like if they need to guide towards a cut in December, they have plenty of speeches, endless speeches where they can do that. So, may as well just hedge your bets a little bit while you have no line of sight into economic data. And then, if you want to pull a dovish move out of the hat, you can do that pretty easily too.
I just think this is like it's another example of the forward guidance experiment. Just like every meeting we're reminded it's so brutal because these people yap every single day of the week, all these speeches, just like padding the resume for the fees when they get out of their Fed seats. And how is this big of a surprise? They literally are talking all day long, giving endless speeches, talking about nonsense. And this one meeting is the thing that changes it. It's just like,
if you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
We've disassociated like actual value from listening to central bankers all the time. And I think therein lies the positioning problem. And I can go through, hit me with slide 41. Now, I talked about this. Market structure has largely changed. And I'm going to go down somewhat of a philosophical rabbit hole here. But because of the 401k system, because of the aging baby boomers and all the systematic quant investing, because we threw due diligence out the door and we wanted to make everything more robotic, they're basically like factories for asset management. And we've scaled asset management in the best way we know how. It's like a big sausage factory, but sausages are gross and disgusting. What happens when everything is managed the same way? Like all these asset managers are managing money the same way, and it used to be completely different. And so this is why volatility is now, when all the data is available for public equities and everyone is reacting to every tiny little data point at all times, everything is known so fast by the machines and robots. So you have to go one step above, which is positioning. And this is why volatility is such an important thing to know now, because this is the buyer on the margin. It creates a divergence in the market. So if everything's a bell curve, right, you have to pay attention to the ends of the bell curve and for distortions. And so what we saw heading into this, we saw the market grinding up in tech right into the tech earnings and Fed. And you can see this is the 10% out of the money calls, which is the orange line, versus the 10% out of the money puts 3 months out. And you can see the pricing. If you take the ratio of these, you can see with that orange line down at the bottom, this is the ratio between the two. When it comes down, that means calls are getting more expensive to puts, meaning I think retail piled in calls on that last, boom, that last like blow off top. They're expecting a Fed ease. They're expecting a dovish Fed. They're expecting, good earnings out of all the FANGs that are reporting this week. And obviously what happens after the event risk is over, volatility drops. It creates, the pricing of your call options goes down. You're forced to sell your calls. The broker that sold that call now has to sell his delta, because this is called, delta hedging. So when you go out and buy a call as a retail guy, there's a broker that sells it to you and then they buy stock, right? And now when you sell that call, that delta gets sold by the broker, and then it continues and volatility comes down. So we saw today, volatility, fixed strike volatility actually fell even as the market went down, which was kind of interesting. So it's a phenomenon of retail setting the price of certain sectors. And I think what we're seeing is just because the market is so centralized and all the giant passive money has basically taken up the floats in different sectors, retail is sniffing out all the gamma squeezes across the market. First, it goes to quantum computing. Then it goes to AI infrastructure. And they go and buy these call options, creating synthetic, gamma squeezes. And then they roll off. And then it moves that to another sector. But the inflows never really are stopping because the underlying economy is still kind of chugging along for growth rates. Mm-hmm. But my point is, this is largely a positioning thing. And if you go one step further down the philosophical rabbit hole, and this is me just yamming from a 50,000 foot view, then I'll just shut up from here. But when you think about this, I call it the financial Hunger Games. Because if the giant asset managers that constantly are getting bailed out by policy, you're raising rates in the markets at all time, or you're lowering rates in the markets at all-time highs. If the mechanism just keeps centralizing power to the larger and larger and larger, and your cost of capital is dropping as a larger institution, then of course this is what's going to happen in the market. This is like Bruce Springsteen's Atlantic City song. Imagine is like, you got to do a favor for a guy, and you're going to take your chance, and you're going to go buy call options and YOLO. Like when your back's against the wall as like a middle class or lower class citizen, or lower income citizen, you're going to take these like wild bets in the market that have payouts because you're getting eaten up by the everyday kind of like dilution in inflation that's happening. Does that make sense? So it's like the financial Hunger Games. You're slowly squeezing pockets of the market out, and the floats are just getting constricted, and you're seeing these like little gamma squeezes here where that retail money will seek out. So that's I think the new market structure we have to deal with. And if you're in when you see implied volatility spike relative to realized, you just have to be really careful. There's going to be a washout. But like, to go down the further rabbit hole is like nothing fundamentally from earnings or anything has derailed this. This is largely positioning.
I think that's what's so funny about comparing just the absolute banger earnings that we've been getting so far this week with just all this hilarious meme. It's a perfect mirror what you just described to what happens at the Fed and this whole idea of forward guidance, right? And just you get these 12 people up there, we go through all these acronyms and people fall over themselves to understand, like, is this QE? Is this not QE? And we'll get into that in a second, but it's just hilarious to contrast these valid obsessions with these flows and memes ideas. And meanwhile, I just saw right before we started recording, Amazon came out with their earnings and it was a huge beat. And, yesterday we saw some more beats, like Google did really well. And so like the core of it is doing really great, but nobody cares about that, right? Like nobody cares about value anymore.
They're the centralized players. This goes back to Hunter's point, is like they're asymmetrically, they're gaining, I guess, power and scale at the cost of the social contract at this point. And this is go to slide 34. I think this just nails everything. Is everyone's like, your economists and Trump, and they're saying, oh, market's at all-time highs, but like this is not good. Like when you have a discrepancy between both parties this far away from each other, like something is breaking here that is really bad. And so this is the difference between, being pride in being an American from a Republican and Democrat. It's the widest it's ever been. I think largely, the stock market structure has a lot to do with that because it's so uneven. Like we've talked about the K-shaped economy, and it's really, I don't know how you solve this at this point.
And what's so interesting about this chart too is you can see like
the
in the early 2000s, we went through different political administrations and it was pretty stable between the two parties, right? Like when George Bush was elected, you didn't see that much despondency from Democrats, and vice versa when it was Obama. But now it's just like complete whipsaws, and then that spread keeps widening too.
Yeah, and there's 4 ways of, you either have AI becomes so productive that you have UBI and then you rewrite the social contract, or it breaks, you have civil war, or you have an external enemy, or you have a great savior who can actually like reunite the American spirit and, get everyone back together somehow. I think it's one of those 4 things is probably going to happen. the irony is that it's probably AI that just does UBI, and everyone kind of, we change it to some weird dystopian thing. Like that's what it's looking like to me, at least.
Yeah, like Amazon blowing out corporate earnings, but then laying off, tens of thousands of people. That just it's a weird world. I mean, to your point, Tyler, the reason people are investing, or if you want to call it investing, trading the way they are, is because the Fed does this repeated behavior where they step in every single time there's a market event, and then they do these occasional rug pulls that rinse positioning. It's but at the end of the day, the trend is very clear in one direction in terms of inequality. So yeah, I think those, what you said about what one of those things that happens, like a strong leader that binds, like that comes after the crisis event. And New York City's election is next week. That is sort of, ground zero, if you will.
I actually had a good contra dystopian thought, which was, what if AI actually works, and the reason why communism never really worked in the first place was because it becomes highly inflationary and breaks everything. But imagine you have this giant productivity boom where everything gets cheaper. Then Mamdani maybe might be the savior in like some rewriting of the social contract in some wacky world. Now, I don't necessarily believe that, but there's a case to be made.
Tyler, I love the way that you can entertain both sides of political thinking. It's awesome. Like you can come up with a thought about rationalizing Mamdani, and then something on the complete other side. It's really cool.
Yeah, like everyone. Well, I guess what it's more just pushing its consensus narrative is like everyone thinks, oh, New York City is screwed. Everything's, and when everyone's saying that, and including me, like I think that too. But I'm like, well, why? Everyone's usually wrong in herd. So what's the contra? And that maybe that's it. And what I do know is that labor is getting pushed so far to the point where something's going to break, and I don't know what that breakage looks like. And the more and more the market goes higher, and the more these corporations make more and more earnings, this is where like your tech bro leadership doesn't really think, like they think long term. They think long term just enough, but not long term to like look at their neighbor and be like, man, that guy's struggling. And I don't know how, I don't want to get robbed. So you're like, I think that's where we have to really think about as a nation, what kind of country we need to have. But I don't see any leaders actually thinking like this.
Yeah, 100%. All right. Do want to cover also the second half of this Fed meeting in terms of the changes in the balance sheet that I mentioned. So there's a couple things as well I just want to unpack, and I'll walk through a few charts here. But first off is we got an update. So obviously, like I mentioned, quantitative tightening is ending, which honestly, it's very negligible impact. We're at like $5 billion a month, I think, of treasuries coming off. So they've already nearly fully unwound it, but now in earnest, it will occur. But what's more interesting is while we've been doing this QT the last couple of years, half of that basket of QT has been treasuries, but there's also been this unwinding of mortgage-backed securities that have been sitting on the Fed's balance sheet that they all bought up in 2020, and they want to get rid of it. They want MBS at zero. They don't want to be in the mortgage-backed securities market anymore. So the issue with this is that the pace of MBS runoff has been a lot slower than the pace of treasury runoff because of extensions that can be done or prepayment risk on MBS makes it so that the actual maturity of these MBS takes a lot longer than what they would like. So it's taking a lot longer for these to come off their book, but they want them off their book. So what they're planning to do now, they mentioned, is that because of the end of quantitative tightening, they are actually, as these MBS mature and roll off their balance sheet, the proceeds, they're going to reinvest it into treasury bills now. Pretty quick, saw a lot of takes about how that's, de facto quantitative easing, and we don't need to unpack that too much. But overall, it is substantial when you pair that also with what I think is likely next to come down the ringer, which is as we're starting to see these funding market hiccups, we're going to get into a realm where we start to see the increase of the Federal Reserve balance sheet. So I just want to start off with slide 10 here. So we've been looking at this the last couple of weeks, and it's uptake of the standing repo facility And this is the clear marker and was the clear reason why they so hastily pivoted towards ending quantitative tightening, is because you're seeing regular uptake on this on a daily basis, not just like quarterly and window dressing type of stuff. So there's clear hiccups in that world. And so what does that imply? It implies basically that they're at very close to scarce bank reserves. There's not enough reserves in the system. And so they need to basically start to change their approach there. And what they're going to do, I tweeted out what I thought would be the steps for this back in September. And so far it's been accurate in terms of the sequence of events. So what has happened? We've seen SOFR creep closer to interest on reserve balance rates. That's happened. And step 2, which I just showed in the last chart, which is just the slow, steady uptake in the standard repo facility. We've had that. Okay, yesterday, now we have confirmation of quantitative tightening ending fully. We have that. The next phase of things is going to be for the Fed to begin to grow reserves through the growth of GDP by buying bills and swapping for reserves, which I kind of put out a tweet yesterday just trying to gauge people's thoughts on this and whether it is, money printing, QE or whatever. But the fact of the matter is that it is coming, and it is something they've been planning for a while. So a lot of people will hear this idea of, okay, the Fed is giving up, QE is imminent, but this is something from actually a 2023 New York Fed paper where this was their forecast of bank reserve levels. So basically the Fed balance sheet. And even back in 2023, like it was fully in their plan to start expanding the balance sheet. You can see in the left chart, which is just the outright level of reserves. Like this is all part of the plan as they get close to scarce and then start growing with the economy. And you can see in the right chart, like as a percentage of GDP, it is pretty flat. It's keeping pace with GDP growth. So what I'm most interested in is to see that once this next phase fully gets rolled out, does that pace of reserve growth outpace this forecast of GDP? Because if it is, I think that's also pretty stimulative. And then the other side of the equation too is I think this is the thing that we've been talking a lot about in recent months on here. It's just the shift towards shorter duration in general in terms of what the Treasury issues, and then also now what the Fed is about to start buying, which is bills. And so if they move into a regime where the Treasury sees that there's this new marginal buy of Treasury bills even greater into the market, you already have that trend happening where Treasury is issuing more and more bills, less and less Treasury bonds because nobody wants to own duration. That kind of gives them the green light to do that and just rip it. Quinn, you and I talked a little bit about this the other day. I'm curious, how do you think about all that?
Yeah, so this move is liquidity positive. So, I mean, even 2 weeks ago, no one thought QT was going to end this quickly. That was just all of a sudden there was a day where JP Morgan and B of A said, we think the Fed's going to end QT next week. And then guess what? They did. So
I said it 2 days before them, though.
Yeah.
Are you in the Signal chat with Nikki Leakes and the ML strategist?
It's me, Conks, Nikki Leakes, and Powell.
Good.
We got to start charging for alpha.
Yeah. So it's liquidity additive, but it's not large. And actually, this reinvestment of the MBS proceeds into bills it could have hawkish connotations from a balance sheet perspective into the future, because it's basically saying we're reinvesting all proceeds into just short duration and therefore shortening the duration of the Fed's balance sheet, which it's better if for the market liquidity if they take down a bunch of duration. And Powell explicitly said they want to move to that, which is none of this is new news. But the thing that it is like the last few years where there's been active Treasury issuance from the fiscal Treasury side, it effectively, they control it. It's because at the end of the day, the Fed might not buy duration, but they can buy bills. And the workaround is for Besant, in the same way that Yellen did, steer more issuance away from bonds. So there's less bonds in the market from the issuance side and more bills that get consumed by the Fed. So effectively, it's the same thing as them just keeping issuance constant, but the Fed buying that duration. It's like tomato. The thing is we obviously don't have good forward guidance into what that Treasury issuance plan will be. But you can read between the lines in terms of all of their buybacks, increasing the active treasury issuance under Yellen, and everything they've done to date is to stabilize market liquidity. And they've also, I mean, there hasn't really been anything around the housing market, but they talk about it a lot and bringing affordability down, or for people. And the best way to do that is manipulate long-term rates that bring mortgages down. And also banks have been buying more mortgages. So it's MBS spreads have been tightening. So you get some improvement there. And mortgage rates are at like 3-4 year lows. So it's working. It's debasing the currency, as you've seen in gold. But I mean, their policies are working and they've gotten oil down. So that's the other thing from the Fed. It's like oil's down. Like the Fed needs more market experience, less academics, because when you look at the reactions in the markets, it's, for one, it's completely opposite of last September, when they actually probably did make a cutting policy mistake. First they were too late, then they went 50, and then they continued to do another 50, and the bond market said, okay, that's too much, because yields flew. And then this time yields are sputtering. I mean, they're still a very bearish trend. They bounce a little, but and the dollar's strengthening. So there's no signs of like an immediate policy mistake. So I think once that data releases, they're going to have some egg on their face, because the job market's going to still be pitiful.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I think what's going to happen is Congress is going to have to do some middle class stimulus package, lower income stimulus package, because I think they're trying to actually help the lower income sectors of the economy that have credit card delinquencies. They have problems on their personal balance sheets. They're trying to but the mechanisms aren't actually working anymore. And therein lies the problem. Is this is actually probably a bigger congressional issue, and we can't even get out of a lockdown. So I don't know how that solves itself, but it's a conundrum. One interesting thing, though, then this is like kind of a divergence, is hit me with slide 37. This is all the high yield companies are actually beating earnings. So as cost of capital is dropping, this doesn't necessarily flow through to the consumer, but it's the companies that are riskier, more leveraged. 45% of them are beating EBITDA versus consensus estimates, and only 5% are missing. This is according to JP Morgan. And then if you go to the next part, this is 7.6 times as many high yield companies have beaten earnings than missed expectations. Meanwhile, only one deal priced for $575 million, which increased October's issuance to $18.7 billion, following September's volume of $58.8 billion. Notably, October is tracking at a 6-month low for capital markets activity. For context, high yield issuance averaged $38 billion over the last 5 months. So there's no high yield issuance. This is like really ironic in October. You actually have less supply, which is why spreads are lower. And it's just like this fascinating. You'd think there would be credit problems, but there's actually no supply. And as soon as more inflows happen, probably in November, like spreads will just come crashing down again. So
this is what I talked about with Hunter last week, where this is the crowding out in effect, because it's so much supply is coming from the government. It's crowded out Main Street and small businesses because they've been crushed. And so they don't have demand for credit because they're struggling. I mean, you can see it in the labor data, and there's no supply. So spreads are super tight, but it just benefits the big borrowers, like the same thing in the stock market.
And then, yeah, check out, this is some of the breadth to your point there. This is slide 39. The percentage of S&P stocks trading above their 200-day movement average has fallen below 60% after a few months holding higher. So people are, there's less and less. And then if you go to the next slide, the S&P is more than 2 standard deviations above its 50-day moving average, yet more stocks in the index are oversold than overbought. The only other times this has only happened 3 other times since 2007. So like, this is everything we've been talking about, is just concentration risk, all happening in one. And then the last great one to look at is slide 44. This is the S&P equal weight, RSP versus S&P market cap weight. And the ratio is the green line below. You can just see the equal weight is just falling out relative to the S&P. It's just like, this is the centralizing, like central banking, hence centralization. Like, this is the centralization blow off top, in my opinion, as we're watching this. And it could go on for a lot longer, but
to your point on high yield companies beating, I've been reading similar about the Russell, and you've had like basically this earnings season is showing, I think across the bulk of corporates, actually accelerating revenue, earnings, and cash flow, beats and estimates. So corporates are crushing it. That's why their margins are going up as they're laying off tens of thousands of people and investing in AI. But even Russell companies, even the Russell index is trading at all-time high valuations effectively. So, or very, very elevated, maybe not as Pico high as like NASDAQ, but so there's just like nothing cheap, and you basically have to dance until the Fed says stop, and you get these hiccups along the way. But it's to your point, Tyler, how disconnected, we are from fundamentals, that this is sort of the environment we're in.
I mean, like, to keep an open mind, I guess, like there's a guy that was like, this is actually justified by large cap tech earnings. Like, it hasn't rolled over yet. And I was like, it is a good point, like, to keep in the frame of mind. I still think the policy is bailing out the much larger players, and it's an asymmetric benefit to them rather than other parts of the economy. And you also have like lots of fiscal policy helping build out infrastructure for AI, et cetera. So they have like this giant tailwind from the government. But to play the contra, like, it is justified by earnings. Like, they haven't blown up on earnings yet. So
yeah, then the charts all look fine for Mag 7.
Yeah.
I think the bigger, like, medium term question though is, I mean, it's like the classic AI bear case that you hear, like, Cuppy wrote a couple of articles about it, but it's just how sustainable it is to go from this regime that we were in of companies like these large cap tech companies did so well and demanded such high valuations because they're so asset light and their margins were so high. But now you're moving into this world where this is a chart just showing the S&P 500 CapEx as a percentage of cash flow from operations. So most of this AI build out has been from cash flow from operations, like free cash flow, just being reinvested in the AI CapEx build out. And so you can see, like, we've been following this trend of decreasing, like, more asset-like companies demanding higher valuations basically since the early 2000s. And then basically since the ChatGPT moment, we've seen this begin to reverse and start to trend higher now. And then you start to look at, this is another one, just looking at the Mag 7 CapEx to revenue percentage. And you can see, like, this, the composition of Mag 7 is changing very, very significantly. And eventually the chickens will have to come to roost in terms of how we want to value that and quantify it, because this, I think there's still a lot of complacency where you think, okay, well, Facebook just sells a bunch of ads and has social media networks, and we can demand this huge growth multiplier on top of it. But it's a fact that these companies are changing quite significantly right now. And so you pair that with what we saw yesterday, which is the Meta earnings came out, and they announced higher than expected guidance on CapEx build out in 2026, and the stock dumped. And at the same time, too, today they announced a bond offering. I think it was for $25 billion, and it was like oversubscribed at $125 billion or something like that. So insane demand for debt to finance this, but still, I think when you look at the high level and zoom out a bit, it's like, all right, two things are happening. These companies are shifting from asset light to CapEx heavy with like huge amounts of depreciation baked in. At the same time, as well as that they're moving from this first wave of AI capex buildup being funded from free cash flow towards debt financing, and that can probably accelerate this trend for the short to medium term. I don't think it's the right time to say, oh crap, we're getting way too over levered right now financing these things. Like there's obviously a ton of demand to finance them right now when you just look at how oversubscribed that meta bond was. But you gotta keep in mind where this all goes over the next couple of years, right? Like if we just linearly extrapolate that to where we end up, you hit this wall where some of these new data centers start to depreciate pretty meaningfully at the same time that you're accelerating the amount of debt refinancing, at the same time that you have this shift from asset light to capex heavy. I don't know where you guys land on all that.
I mean, at the same time that these companies are 40% of the S&P, and if they go down, the retirement system's screwed over.
Yeah.
So it's like you just basically wait until it's like, yeah, I mean,
welcome to the Ponzi.
Yeah. Like
when you boil it down, the economy and the pension system is funded by NVIDIA graphics cards.
Yeah, exactly. And these,
So true.
The thing is we're still at the step where, okay, Meta was the first company punished for the CapEx. So the next steps we have to go is, okay, some worries about that. And the corporates actually say, okay, investors are starting to catch on how much money we're funneling. Maybe we have to pare back CapEx. We're just at the tip of the spear. And then, so Meta's getting questioned about their CapEx number. Oh, but they're still plowing through and taking it because they, as Zuck said on that interview, he said, if we don't invest, we're at risk, or, we can't spend enough money, or whatever his quote was. And he's like, oh, we just threw hundreds of billions at this. So then the next step is they say, oh shit, our stocks are getting hit. We got to pare back investment. And then that's when NVIDIA, who just went over 5 trillion market cap, gets hit. But then when NVIDIA gets hit enough, that's when the Fed steps in, and that's when Bitcoin and liquidity does good. So it's like,
and then NVIDIA just does a new partnership with OpenAI, and then
and the circle J continues.
Yeah,
it's
hey, wait. There's this. So this is actually a fun intellectual thought subject. So obviously, when you take out debt, that becomes someone else's revenue, right? And so, but the problem is that who's the end client? You need basically the end client to keep, ringing the cash register at the end of the day. You can't just have it be the CapEx bubble needs to be backed up by revenue from the end client, right? And so there has to be new industries that spring up from this productive AI capacity. From all the job losses that are happening at first, you'd expect, oh my God, people start figuring out how to use this stuff, and then new industries spring up. Like that's the Goldilocks scenario. But then check this out. This is fascinating. This was from the Meta earnings. He says video is in a particularly bright spot, with video time spent on Instagram up more than 30% last year. And as video continues to grow across our apps, Reels has an annualized run rate of over 50 billion. And I guess what I'm just trying to, like, it's just an attention economy, and those end consumers actually have to make money eventually. They actually have to make money from some other part of the economy to pay the big fangs. Not only are the fangs taxing every corporation on the planet, but then there has to be an end consumer. But what is everyone just plugged in all day long? Just staring.
That's why the fangs need autonomous driving, so you can just sit there on your phone while you're driving too.
Yeah, you can watch their AI slop sonar videos,
and it's such a
with weird AI slop ads in it in your self-autonomous car.
Yeah, it's such a disgustingly dystopian. Like, I'm surprised there's not more of a backlash of like disconnecting and going into the woods and
I think the bottom line is how like people still like. We still do not talk about and appreciate enough as a society how much every person is the product, is being played by all of this. But you have to do it because, like, if you don't keep up with AI tools, you're like a deadbeat at your job. So you have to keep running on the hamster wheel of like plugging in more and more to technology, and it's like you can't stop. Otherwise, you don't work in society. But also it separates all social fabric, and like the beauty of life in general, to like spend time with people and outside and like real life experiences. And now it's just AI goggles, robotic friends, and virtual avatars.
AI girlfriends and OnlyFans. And you're like, great. Great society, man.
Yeah. Weird.
At least we can make crappy jokes on a podcast.
Well, pretty soon, this is just, an AI is going to feed in like all of our podcasts and just say, hey, these are the news events. This is Quinn, Tyler, and Felix. Create an hour of what they would talk about with these.
Yeah, this one could be AI. Maybe people don't know that yet.
You can't meet my crappy dad jokes. No AI could do that.
Yeah,
true.
Exactly.
Or your outfits.
Yeah.
AI haircut. They knew he was real when they said,
why are you roasting me so bad? Feeling very sensitive.
Because we keep getting whacked on trying to buy the dip in Bitcoin.
Yeah, what is that about?
Who's sell? I don't know, man. This is the thing. Like, you look at the fundamentals, it looks good. Like, I still bang the drum that 2026 is gonna be awesome, and I kind of have felt hesitant about the fall leading into then, but man, it's tough to navigate this. The chop is brutal.
I think what it is there's no new, like, when you really back up, and it's been frustrating, but when you back up and there's no new incremental money going, there's no narrative to create price growing up. Like, there clearly is, like, the same narrative is happening in gold. There's no doubt that there is an increased allocation of capital in the gold sector on an institutional basis. And that is not necessarily happening, I don't think, at a global level for Bitcoin and crypto anymore. Like, especially, like, how many new funds have that have been created in crypto? Like, not many.
Just a lot of
but
DATs.
The ETFs, the DATs is leaving a bad taste in people's mouth and posing a big risk. Today MSTR and BMR got smoked, but the ETFs are, the ETF AUM is like a straight line, long-term trend. I just think that, like, any new capital or macro managers, like, probably saw yesterday and was like, okay, I'm not going to be piling on more Bitcoin when Fed's, threatening hawkish tilts. And if you look back at, honestly, the last number of Bitcoin moves, you basically need, like, the August 2024 Fed pivot from the VIX event, the April 2025 Treasury fiscal pivot from Liberation Day event, VIX event. Like, it's become this thing you just buy out of the hole and just never own it for 20 days of the year and never again. Like,
yeah, I think a lot of it is idiosyncratic. Like, 2024, the big marginal buyer was DATs, and they're definitely not buying anymore. A couple of them are starting to sell, still small size, so it's not like huge amount meaningfully in terms of flows. And then you have a lot of people that are selling because they think 4-year cycle top. So you have a lot of crypto natives getting out there. I don't know. Like, I think we'll be right eventually. It's just about when and trying to survive the chop and leverage long liquidations. Like,
we're also only down
leverage long. Don't
on Bitcoin.
Don't leverage long. Like, don't own stupid altcoins that have no marginal buyer to them. Like, just.
I think perps are actually hurting the market. I think that market structure is actually really bad. In fact, the market structure, this is where I think this is a message to all people releasing 5x levered single stock ETFs. You are doing a disservice to your children.
Bro, it's only going to get worse.
You gotta look at your face.
They're coming to equities. It's only going to get worse.
This is we effectively we've abstracted. The market is now casino. That's what it is. And it's an addiction mechanism, and it's really messed up.
It's going to get worse. Think of how many people, think of how small the perps market of crypto and trading perps is relative to the financial system and equity market. And now imagine the perp market going to equities in your Robinhood account that sits next to your sports gambling portfolio, which is alongside your investing in your, it's like, but it's Weimar America. Like, you have to participate. Otherwise you're eating bugs.
Yeah.
But man, like just do it in a right way. Like I'm just looking right now at MSTX, the 2x long and like MicroStrategy. It's down 67% year to date. Meanwhile, MSCR is down 15%. You know, Bitcoin's what, like 20% year to date, or not even now, like 12%. So
No,
yeah,
it's
like
up.
yeah, it's up. Sorry, yeah, it's up. So you can have you can have the right idea, but you buy the wrong asset, like a 2x levered long ETF, and just get destroyed.
Yeah. That's why timing's so important. But I think this reminds me like every single dystopian novel, like Ready Player One, where you have to do something divergent to like, and you hear about the person who made $1 million, $2 million off of a call option trade, and then everyone tries to replicate it. And it's just, that game is so hard to continuously play. The only way you can beat the house is you have to have longer term incentives. And therein lies like, I think that's really the arbitrage, is things in the private markets. They have longer term holders, longer term incentives. They're building, they're creating. And in the public markets have largely abstracted that incentive system. High frequency trading is like 60% of the volume. It's a casino. And pretty soon I'm actually wondering, when the pensions figure that out, it's like, we're the bag holders here and there's going to be no one to sell to if you don't fix the market structure. And I think that's a generational issue.
That is also when you attack the integrity, like that's something that solely, when you have all the grift and Ponzi's and fraud and stuff, that's solely under that, you don't see it overnight, but it undermines integrity and people's trust. Like all the insider trading around administration or the debt, like you can't erode people's belief in the integrity of the system for too long without negative repercussions, which goes for it's not just our markets, it's our political system too.
Yeah, exactly.
What you really need, and this is actually kind of fascinating to think about, I just thought of this, is as a CEO of a company, you actually like need to say, this is a long term. As a holder, I don't want you, like Palmer Luckey actually says this. He's like, I don't want you if you're going to hassle me. I'm going to do what I do, and otherwise get off my cap table. And you need CEOs to kind of say, this is the type of investor we want for the next 20 years, and I'm going to make you wealthy. And I don't want the person that's going to jump on the bandwagon for 2-3 months and then, get off, or the hedge fund that's trying to beat next quarter's earnings. Like that's ruined American incentives. And you're extract, we all play that game. I'm kind of a hypocrite saying this, but we're part of, a lot of senses, but I would love to invest in something and somebody I believe in over a long period of time but it just is hard to come by.
I mean, directionally, I think that's why I actually really agreed with the approach of potentially going to two earnings reports a year as opposed to 4, because it helps align time preference a little bit better. Like I think it isn't a coincidence that we see such a lack of public equity at the same time that there's this frustration with, because if you go public, you're just at the whim of like quarterly earnings analysts and all that thing, and that you can't think long term. And I think that's a really valid concern right now.
It's a double-edged sword, because then all the hedge funds have all this data, all the big centralized players have all the data. I don't have any clue what's the right answer, but so you basically have like the average Joe is more in the dark, and the hedge fund's edge of having all this private, data increases. I don't know what
that's a good point. Is. Yeah, it's a hard one.
In a world of centralized data, it's just, I don't think this is where, if you talk about like Pareto's rule, the 20% outperformers are going to just keep compounding wealth. Like, and that's in this new world when you have all the data and you can look at everyone's history of everything they click on. You're way more powerful than your average consumer, which sees like a snippet of it. And so I don't think there's a leveling of the playing field until you figure that out. Wealth is going to compound in that upper echelon no matter what.
Yeah, and that's not stopping when the government's continuously writing checks to the AI companies and bailing every 5% market correction out.
Vote Mamdani.
I mean,
Like you can
There's
see
gonna
how
be-
people get there. I mean, like I have the end result is that's
100%.
There's gonna be 10 Medmanis in this country in 2 years.
yeah,
So,
that's
just
the
the tip of the spear.
Unless you fix inflation and wealth inequality, like that's the trend. 100%. Yeah.
On that rosy note, what are you guys doing this
On
weekend?
Yeah.
On the next forward guidance, we're going to be talking about signing up for OnlyFans. Everyone can have their own OnlyFans.
Or
We're
sports
sponsored
betting
by
fund. Yeah.
yeah, or we're sports betting and like
Slopification.
yeah,
Find some meaning out there. Hopefully, that's what I'm going to do. I'm going to try and find some meaning in life this weekend.
yeah, that's it. Yeah.
Probably some outdoor stuff.
Yeah, exactly. Honestly, that's the correct.
Go get
answer.
out there and be nice to people face to face.
Yeah.
Exactly. Yeah. All right, guys. Have a good weekend.
We'll talk soon, boys. Later.